Good afternoon. You're watching Business World Live. I'm Jes Delos Santos. Let's take a look at how the local bourse closed today, Wednesday. Things not looking rosy ahead of the GDP release tomorrow. Local shares extending its drop further Wednesday. The main index sank by 1.6% today, down to 6,863.61. At one point, it even had a deeper plunge at 2.2%, barely holding on to 6,800, but managed to trim those losses before the close. Investors proving to be cautious as growth prospects for the country remain bleak. That's following weak trade data in December. That has been reported earlier, but for a quick recap here, exports declined by 0.2% in December. Imports likewise plunging sharply, down 9.1%. That pushes trade deficit to its widest since March at $2.181 billion. Farm output also not any better here. That contracted 3.8% in the last quarter. That's not helping lift sentiments for tomorrow's release of fourth quarter GDP data. Worries now linger over growth prospects here in a Bloomberg survey. Estimates for the last quarter's GDP is that it has contracted by 7.9% year on year. That's also following a revised 11.4% strength in the third quarter. Jonathan Ravelas of BDO says the contraction in the last quarter might be deeper than forecasted, making sentiments more bearish. Now, should there be more disappointing data by tomorrow, Ravelas says expect the index to dive further to 6,500 within this quarter. Gokongwei firms leading declines in today's trade here. If you try with both JG Summit and URC here, leading declines here. In fact, they are both of them at least down by over 5%. Let me just change my chart here very quickly. Here you'd see here JG Summit's deepest fall here, at least in any full day loss since June 2020. It is down by 5 3/10%. It's now priced at 66 pesos and 70 centavos a piece. While URC, as you can see here as well, also in the red, they're down by as much here, 5 3/10%, now valued at 143 pesos per share. Their property arm, Robinson's Land, is also now down to 18 pesos and 98 centavos a piece, leading the drop here in the property space. That's following a report from Business World that Manila's appeal as a real estate investment destination in Asia Pacific has already dimmed. In the latest study of the Urban Land Institute and PricewaterhouseCoopers, the capital's property market has fallen to 19th out of 22 Asian cities. The study notes how Southeast Asia has been a high-risk play during recession, and that pretty much has hurt NCR's reputation, along with Robinson's Land. Ayala Land as well dipped by 3% here, while SM Prime as well slipping 2 4/10%. As you can see right here, the biggest mall operator in the country has also just set interest rate of its retail bonds due for 2023 and 2025, an aggregate amount of which is at 5 billion pesos with oversubscription option of another 5 billion pesos. However, SM Prime shares so far, at least ending Wednesday, down to 36 pesos and 80 centavos. The counter as a whole, as you can see right here, is also edging lower, down by as much as 2.5%. But bucking the sell-off in local shares here, Macro Asia, that's despite the cancellation of its bid for the $10 billion Sangli International Airport together with China Communications Construction. That's due mainly to deficiencies in requirements, says the LGU, meaning plans for the airport are now back to square one. This news pulling Macro Asia shares down by as much as 13% earlier in the day, but it has since regained some strength here. In fact, it ended the day in the green, up 0.4% to 5 pesos and 55 centavos a share. Moving on now to the banking space, Ayala-led commercial bank BPI is in the right track after announcing its consolidation with its thrift banking unit, that's according to S&P Global Ratings. Philippine Star reports that the debt watcher sees the merger between BPI and BPI Family Savings Bank as a way to boost operational efficiency. S&P said that with the shift to digital banking during the pandemic, the consolidation would allow BPI to focus on enhancing its online infrastructure. However, the credit rater said the merger would only have a minimal impact on the bank's credit profile of BBB plus with a negative outlook. BPI shares ended the day higher, up a quarter of a percent to 83 pesos and 15 centavos apiece. Now, here are other headlines we're keeping our eyes on. Farm output contracted by 3.8% in the fourth quarter of last year, dragged by decreased production in crops, livestock, poultry, and fisheries. Crops, which account for more than half of agricultural production, contracted by 0.4%. Livestock posted the biggest decline of 13%, with hog raisers seeing a nearly 14% decline in output. Poultry and fisheries also posted declines in production. Back-to-back typhoons caused massive damage to agricultural lands in November last year, pushing prices of vegetables and other prime commodities. Lingering threat of the African swine fever has also affected hog and pork products, prompting government to consider a price freeze on key food items. Despite lower production volume, though, the value of farm output at current prices is still 5% higher than the 2019 fourth quarter figure at 504 billion pesos. Now, focus on Build, Build, Build may have led the Philippine government to overlook funding for social services such as healthcare, and this exposes the country to highly negative risk. That's according to Moody's. The debt watcher says the pandemic has highlighted existing gaps in health infrastructure in some parts of Asia, particularly in the Philippines and India. Moody's noted the quote, traditional emphasis on supercharging growth through infrastructure spending. Moody's says the pandemic may still take a turn for the worse, potentially straining the public health system and disrupting business activity. The credit rater expects Philippine economic growth at 7% this year, up from its previous 6.2% forecast. However, it sees Philippine recovery lagging the region. Now, if the pandemic surprised businesses in 2020, 2021 will be about thriving in their digital transformation, especially as the crisis lingers on. To talk about how companies can better equip their workforce, we have Praveen Kumar, General Manager for Asia Pacific at ASG Technologies. We speak to him straight from Singapore. Good afternoon, Praveen. Let's kick things off. What were the major challenges here that the pandemic posed for Philippine firms in 2020? What were the lessons learned, basically?
Hi, Jes. Thank you for having me around. I think in 2020, the biggest challenge that companies in Philippines, especially the mid and small enterprises, faced was their lack of digital transformation or digital enablement. More than 99% of registered businesses are micro, small, and medium enterprises in Philippines. And most of them did not have digital as part of their roadmap or implementation ever. And that has caused a significant issue because most families during the lockdown were ordering even food, groceries, or regular stuff that they would normally go to retail shops in online. And the lack of digital presence did cause a lot of trouble for these enterprises, which was not the case with the larger enterprises who are in retail or in oil or in BPOs or even banks, where their digital transformation was already in process. So that was the biggest impact. And that was the biggest learning for them, that if you are not in the digital space, then not only are you losing out on potential businesses that can come your way, but it can impact basic top line that would never be there in cases of pandemics like these.
But would you say that there was at least a quick adoption when it comes to digital transformation during 2020?
So that is something that everybody had adapted to. So survival of the fittest, so to say. So whoever did think that the only way you can survive is start adopting digital, started moving in that direction. And companies like ASG helped them with software where they could migrate from a conventional platform to a digital platform in as quickly as maybe 3 to 5 weeks. And that enabled them to not only launch mobile apps or have web infrastructure which could immediately go on. And the availability of cloud was a big bonus because they did not have to deploy on-premise infrastructure to actually go on the web or go digital. So they could just host the application on the cloud or the website on the cloud very rapidly and move forward. Still, I would say a lot of enterprises did a very haphazard, shabby job in terms of trying to go online and learn on the job and try to fix things. However, I would say there's a long way to still move forward.
Okay, so a long way to go, but just to be forward looking here, what should be the trends here that enterprises should be watching out for this 2021?
The interesting part was everybody was second guessing how long would this pandemic last. So if you were to speak to me in March of 2020 when it was actually at its peak, I would have said, oh, maybe it's going to go away in 6 months and we'd probably have a better outlook towards the end of the year. Move forward to June or July, then it started saying, okay, we may have a vaccine by end of December, so maybe we'll be out of it in early March. You just rewind back and look at Malaysia, which is having one of the highest second phase of growth apart from Europe in terms of the pandemic. We don't know when it's going to end. And that actually put a hurdle on a lot of investments that people did not do. They said, okay, if it's going away in 4 to 5 months, why should I go and retransform my business for 4 to 5 months? Let me just hang around. Anyway, there's a lockdown. And then once it's back, I'm back in business. Now that unknown, because of the timeline, and when I speak to customers today, they say they have no clue as to when things would go back to normal. Singapore, in fact, said that airline travel is not going to be normal till March of 2022, which is almost a year plus 2 months away. And that has enforced digital transformation at a higher pace and remote ability to work. So you can call it remote work. We now call it work is the norm. If you're remote, if you're not remote, then you're not working. And that has enabled remote working, digital enablement, ability to reach out and control data remotely, etc., very rapidly. So we have a lot of customers who come to us today and say, I want to get remotely enabled support my customers who could be anywhere in the world rapidly, and can you build something for us in the next 4 to 5 months? That's going to be 2021 because of the unknown that nobody can predict today.
Is this something that's going to be across the board here, or are there any sector in particular that has to take better advantage of these new trends?
The sector that has taken advantage of it already is the financial sector. That's the sector that has, as you just mentioned in the news just before, that credit growth is expected to grow compared to the earlier metrics. There is a net interest income for most banks across the region, including Philippines, which is growing significantly. At the same time, the digital footprint has increased dramatically. That has reduced costs. For banks, the biggest cost was the branch enablement cost, where they had to keep people on the job, get people coming on site on the branches and enable them and manage security and all the activities that happen in a branch. Going digital, where a lot of business actually went online, helped them not only save costs, but helps them in the journey to move everything online a lot quicker. So the industry that benefited a lot with the pandemic is fast forwarding, and they were already investing in the transformation space. Digital is banking. Most of the industries, the only industry that possibly did not have to go online is the oil retail industry, and the automotive industry to some extent, because you're not going to drive cars online or buy oil online. The automotive industry, in fact, took up, and we've had a bunch of companies which said that we would now like to customize cars online. So you actually choose the car online, you choose the color, you choose what you want to do, and then the test drive just comes in. The guy comes with a specific model and specific car to your house and moves forward. So basically what it was allowing you, almost all industries have to go in. There might be some industries where going online would be slightly more staggered because of the lack of need, or where the customer has to go offline to actually go and engage.
Okay, so definitely different sectors, different experiences, especially when it comes to digital transformation. But the point is, there needs to be at least an adoption to going digital. Thank you very much for your time this afternoon, straight from Singapore. Again, you have Praveen Kumar, General Manager for Asia Pacific of ASG Technologies. Thank you, Praveen.
Thank you, Jes. Thank you.
And those are the biggest news this trading day, January 27, 2021. Catch Business World live again tomorrow at 9:30 a.m. for the market open and 3:15 p.m. for the market close. I'm Jes Delos Santos. We are One News.